So there are three exchange rate learning objectives we want to meet in this video. And so first thing we want to do is analyze how the exchange rate is managed under a fixed system and a managed exchange rate system. We also want to look at how a government revalues and devalues its exchange rate, or how a central bank does the same thing. And we also want to know the differences between a revaluation and a devaluation. And finally, we want to analyze the causes of changes in the exchange rate under different exchange rate systems. So let's get started. So how are exchange rates determined? Well, for fixed exchange rates, the government sets the exchange rate and the central bank directly intervenes by selling and buying the currency and changing interest rates to influence hot money flows. Not just hot money flows, but also exports and imports and foreign direct investments. And so this is easier to maintain if the fixed rate is set at some kind of long-run equilibrium. And it's good for certainty of trade relations, because if you know how much something's going to cost in another country because exchange rates are stable, you increase your own chance of doing business with that country. There are a few negatives though. And one of the negatives is that there's an opportunity cost of holding foreign reserves or gold. And it's because in order for us to fix the exchange rate, we have to be constantly selling and buying currency. And so we have to hold foreign reserves. And if we're holding foreign reserves, then there's an opportunity cost of holding foreign reserves. Because while we're holding foreign reserves, we can't do anything with that money. There could also be other policy conflicts with exchange rate policy. And so we might want to keep our exchange rates depreciated and devalued low, but we might cause inflation because we're consistently pursuing an expansionary monetary policy. And that might also dampen our ability to handle a fast-growing, fast-expanding economy. Now, this also requires adjustments over time as economy changes. And so as an economy changes structurally, there might be different trade patterns that the economy adopts. And as a result, the exchange rates might fluctuate, right? We might have a new long-run equilibrium. And so it becomes harder and harder to maintain a fixed exchange rate if our long-run equilibrium consistently changes over time. And so that's why we have something called the managed exchange rate. And so the government sets an upper limit labeled here in PA. It's an upper limit, an upper band, and a lower band, as well as a central value, PC, for the exchange rate. And the central bank's job is to maintain the exchange rate in between the upper band and the lower band. The central bank will actually only intervene if the rate goes above or below the bands. And so there's less strains on reserves, but we're introducing a little bit more uncertainty on exports and import prices. And so a country like China, because it's an export-led country, wants to keep its exchange rate deliberately low, runs a managed exchange rate system. And so that's why not only do you see China holding large amounts of foreign reserves, US-denominated reserves, it also has very strict portfolio investment and foreign direct investment policies, because it does not want to open up the floodgates of investments, because that might drive its currency up. Now, let's talk a little bit about revaluations and devaluations. These are different from depreciations and appreciations. If a government lowers a fixed rate, it's called a devaluation. It's done via lowering the interest rates and selling its own currency by buying foreign currency. So it's a deliberate move by the government. Similarly, when the government raises its fixed rates, we call that a revaluation of currency. It's done via increasing the interest rates and buying its own currency with foreign currency. And so this is another deliberate move. Now, note, the valuations and revaluations are actions by the government and central bank, while depreciations and appreciations are the result of market forces. And so if we're talking about the value of an exchange rate changing, in a floating exchange rate scheme, then we use the words appreciation and depreciation. If we're talking about the government and central bank deliberately trying to influence the exchange rate, then we use the words devaluation and revaluation. Now, floating exchange rate influences, what are we talking about? Well, what factors change the floating exchange rate? Well, demand for the country's goods and services, exports, and demand for imports. Both of these work to change a floating exchange rate. Changes in the financial account, what we talked about, right? Foreign direct investment and portfolio investments change the floating exchange rate, as well as hot money flows, right? Short-term deposits of money moved around the world to take advantage of short-term changes in interest rates and exchange rates. These influence the floating exchange rate. And so if we want to adopt a fixed exchange rate system or a managed exchange rate system, then we need policy to manage each of these separate parts. Now, if a country has a fixed exchange rate, then what is it influenced by? Well, there are 4 things. Number 1, the government prefers to use reserves to mitigate downward pressures on the exchange rate. Now, the problem of that is reserves might run out unless we have a huge amount of foreign reserves. If our exchange rate keeps deviating from the rate we set, we might run out of reserves just trying to manage the exchange rate. And so the first influencer is reserves. The government is also reluctant to get the central bank to raise interest rates because it is contractionary. So the second influencer of fixed exchange rates is the interest rates, but the government doesn't like to change the interest rate to influence the exchange rate because it might influence the economy at large. So increased international competitiveness is also an influencer of the fixed exchange rate. There's an incentive to devalue in this situation because we want to sell more exports. Now, if there is increased international competitiveness and we devalue and we sell more exports, then we reduce the current account deficit, we can cause economic growth, and we can decrease unemployment. If we fix our exchange rate and we refuse to devalue it, even though we have better products than products that are from overseas, then we give up all of this benefit. So the fourth influencer of fixed exchange rates is if there's too much upward pressure on the exchange rate. Now, in this situation, there's an incentive for the government to revalue the exchange rate because if they want to keep it low, they have to keep selling their own currency. And this comes with the additional effect of increasing the money supply, right? Which is technically a monetary policy. Now, we don't want to increase the money supply if we don't want monetary policy effects. And so in that situation, the government might not have an incentive to increase the money supply. Now, another situation is that if we're able to revalue the currency, we're able to make import prices cheaper. And that might be a reason for domestic firms to innovate on their products so they become more competitive internationally.